A very warm welcome to everyone who has joined us for this conference call or webinar, should I say, this morning, Creating Certainty in Taxing Times. I think it's anything but certain out there for our South African expatriates around the world, but what is certain is that their tax situations are going to change. One of the real challenges is the lack of clear information available to advisors to address the issues that this particular diaspora of client is facing. And then the other challenge is actually a solution. There's an awful lot of talk out there and commentary, but none of it is really looking at how to provide solutions to the problem that these people are facing. The problem obviously being they're going to start paying income tax on their income for the first time. In a number of jurisdictions, so a significant cost is potentially coming their way. What I'm going to cover off today is I'm going to look at the South African tax system, give you a bit of insight into that. I know we have a number of South African advisors online, so bear with us as we go through that. We also have a number of international advisors from different countries. We're going to look at the position post 2020. I want to talk a bit about residency and dispel some of the myths. I think this is one of the areas that has been been made very complex needlessly, and also dispel some of the myths around the concepts such as financial immigration and double tax treaties, how they do or don't work. We'll also look at some of the exemptions that are available to these individuals, both pre and post retirement, and also touch on some of the contractual devices that are available to them in order to help normalize the tax position that they're facing. And then we'll look at that in the context of broader financial planning. One has to remember these people have existing assets and income from those existing assets, as well as earned income. And one needs to consider all of that in the round and not get totally distracted simply by looking at the earned income position. Who is the client? We're specifically talking about South African nationals who are working permanently abroad but intend to return to South Africa, or South African nationals who work abroad on a periodic basis, typically contract workers who are specialized in their field. They'll go abroad, do a contract, return, and so they will operate for a number of years, often with the same employer, often with multiple employers, often in multiple countries. What these two client types have in common is the intention, or the reality is that they do return to South Africa on a periodic basis. They'll have a home in South Africa. They may or may not have personal interests in South Africa, including family interests, and they might also have economic ties in South Africa. And that sort of sets the scene, I hope, as to the kind of client that we are dealing with. Your South Africans that have left the country, live abroad, have no intention to return and have no ties with the country, pretty much safe to say that they will not fall within the new legislation. So if we turn to tax and law generally, and look at the nature of taxation in South Africa. So we have a residency-based system for taxation in South Africa. In other words, an individual who is resident in terms of the Income Tax Act in South Africa is subject to tax on their worldwide income. So it's a very broad, all-encompassing powers that the legislation bestows on the tax authority to collect tax on a worldwide basis. This obviously becomes incredibly relevant where you have income outside of the country, as most of the expatriates do. However, to be resident for tax in South Africa, there are two tests, both of which must be passed. The first test is the physical presence test. Now, this is a rules-based test, and it's encoded in the Income Tax Act in South Africa. And it's very straightforward. You need to spend 91 days in a calendar year in the country. together with 91 days in each of 5 years, consecutive 5 years, including the current year, and a total of 915 days over that 5-year term. So if you meet those conditions, you are ordinarily resident, you are resident for tax in South Africa. As I said, it's rule-based, it's very easy and simple to work out. The majority, however, of South African expats fail this test. In other words, they are not tax resident in terms of the physical presence test, which then moves us on to the concept of ordinarily resident. The challenge with ordinarily resident is that it is not a term which is defined in the Income Tax Act. So we have to look to domestic South African law to understand the definition and the legal interpretations of the concept of ordinarily resident. Now, if you are going to be dealing with South Africans, I recommend that everybody has gone and read the practice notes that have been issued by SARS. That's the Interpretation Note 3 of 2002, which really gives you a very good understanding of how SARS approach the concept of ordinarily resident, which is all based on the jurisprudence in South Africa. In other words, it's based on the case law, the common case law in South Africa defining ordinarily resident. Now, to put that all into normal speak, what the law has basically said is that the place that you return to after your wanderings is effectively your home, and it is your home that determines your residency in terms of ordinarily resident. The implication for this is that if your expatriate, South African expatriate client, their intention is to ultimately return to South Africa, they are ordinarily resident. Just by having that intention confirms their residency in terms of ordinarily resident status. However, there are other facts that one has to go on, and this is the key difference between the physical presence test and the ordinarily residence test. Is physical presence is rules-based, ordinarily residence is fact-based. And again, if you look at the guidance issued by SARS, some of those facts that you'll need to consider when speaking to a client is things such as, do they have a home available to them in South Africa? Do they return to South Africa on a periodic basis? This concept of habitual abode is very important. So let's give you an example. I have lived and worked in South Africa for a period of time, following which I take up a contract in the Middle East, and I've now spent 5 years working in the Middle East, or 10 years. But I do return to South Africa from time to time. This is the concept of habitual abode, where you are returning to your home, albeit your temporary home is in the Middle East. There are a lot of other considerations as well, such as your status in the country that you're living. If you have a temporary residency, or you're working on a visa which has an expiry date, your tenure in that country has a defined term, following which you will no longer be able to stay there, which supports the concept that you are ordinarily resident. If your family interests are in South Africa, your wife, your kids, or your spouse and your kids, again, that's a clear indication that your home is actually where your family is. So as I said, it's important to read the interpretation notes, and the vital crux of the matter is that, as I said at the start, it's only if your client is resident, either through the physical presence test or the ordinarily residence test, does the new legislation apply to them. So determining residency is really the first step that one has to take. What we've seen is a lot of people, a lot of clients, should we say, like to put their head in the sand. They like to try to argue the argument for being non-resident. But the reality is a significant number of them are clearly ordinarily resident. And I suppose it's not wanting to accept the fact, is which a number of clients are trying to deal with at the moment, because they see the implication of taxation coming in. I think that sort of moves us on to the next point, which is double tax treaties. As you can see from the ordinarily residence test, it's not always that straightforward. And the reason for that is you might have a home in more than one country. You might have a home in the Middle East and you have a home in South Africa as well. And this is where the double tax treaties come in, because what the double tax treaty does, it actually determines residency. So it'll have its own mechanism for determining residency. And I've taken the South Africa UAE DTA as an example, and what we have here is, if you read the DTA, it says the purpose of the DTA is effectively to prevent double taxation and also fiscal evasion in respect of taxes. So what that means is it's looking to exempt, it's looking to ensure that you don't pay double tax, but there's also no double non-taxation which occurs. I've just got some texts coming through. I'll deal with those texts shortly. Thanks for the people that are sending through some chats. I'll deal with them in a minute. I'll just get to the end of this slide, and they're questions in relation to the slide. So if we look at the DTA, and particularly the DTA in respect to the UAE, and we look at Article 4. Article 4 is the article which determines residence. And it's pretty much designed around the concept of ordinarily residence, because it goes through a series of questions, such as where is your home, where's your center of economic interest, where's your family. And in many instances, you'll find your client can answer the affirmative to those questions in relation to both territories. In other words, maybe it's the UAE and South Africa. They have homes in both of them. They have family in one, but they have economic interests in the other, etc., etc. So it becomes quite difficult to actually determine residency. The important clause in that treaty, and in most other treaties that South Africa has, of Article 4, is 2C, which basically says that in the absence of being able to create a clear picture as to where residency lies, one goes back to nationality. And I think for a lot of South Africans, this is sort of the Achilles heel. Because they will generally only have nationality in the country that they were born and not in the country that they are working in, and therefore residency, or ordinarily resident, they'll be resident in terms of the treaty, in South Africa, and therefore ordinarily resident. So I think this is one of the challenges of DTAs. Is that they aren't there to give you protection from tax. They're there to define where you are resident for tax, and then once that residency has been defined in terms of the treaty, which might be very different to your physical residence, it then bestows the power of taxation to the relevant tax authority. But the South African DTAs have been very cleverly worded, because they do use citizenship in the residency clause as their sort of catch-all or final test. And their final test. People have asked me, saying, well, what happens if I've got a South African living in the UAE with a British passport? We have a lot of those. The point is, the DTA doesn't consider nationality of a third state. It only considers nationality of the states that are being looked at in terms of the treaty. So the UAE and South Africa, for example. Or it could be South Africa and another country. So a third territory passport has no bearing on the DTA. I've also put a picture in there of the scales of justice, which really looks at the concept of international law. And what's the bearing on international law in relation to this whole topic? And the point there is that the South African Constitution, which is a very good constitution, actually adopts international law as a superior authority to domestic law. And what this means is that the outcomes under a treaty are binding on all the residents and citizens of South Africa, as they would be on the residents and citizens on the UAE. So you have a legal framework for the enforceability of DTAs, both at government and individual level. Which is very important. So that this whole concept has authority in terms of law, both domestically and internationally. which is obviously enforceable. So that's the position in respect of taxation, and obviously the key bit being here is determining residency. And if your client is ordinarily resident, then the new legislation is going to apply to them. Just move on. I'm just going to get the next slide up. For some reason we got it. There we go. It's taking its time. Okay, so let's look at the actual legislation itself. And see when it's coming in. What does it mean? And then we're also going to look at the options that people have given this legislation. So I think we all know it's coming in on the 1st of March. So that's 2020, from the start of that tax year. And there is an exemption that is available. So the first R1,000,000 that your expat earns will be exempt from tax, provided they spend 183 days out of the country per tax year, and 60 of those days must be consecutive days. That is obviously a very valuable exemption. If you have your transient or contractual workers, it's really important that you speak to them and ensure that they stick inside those provisions so they can get that R1,000,000 exemption. Otherwise, their full income will be subject to tax. So for a lot of people, the introduction of tax actually won't have any bearing, because they're really going to be earning under the R1,000,000 mark. However, for people that are in excess of that, what are the options for them? Now, SARS, South African Revenue Services, and National Treasury did a consultation in 2017 before proposing that this legislation came through in 2020. And it's a very interesting consultation. And there are several outcomes of that consultation. And the guidance from Treasury was as follows. Expats need to consider the adjustment of their contracts. They should consider pension provisions. They should consider changing their circumstances. And lastly, formalizing their tax status. So what do they mean by all of this? Well, the first bit is A, that's on my slide, which is this point on adjusting contracts. And the one peculiarity with regards to the majority of expats is most of their earnings, or all of their earnings, are cash. They have very, very few benefits, and it's generally high salaries, because they're living in zero tax jurisdictions. Very different if you're living in the UK or another territory. So what one means by adjusting contracts really looks at adjusting that employer-employee contractual relationship to introduce, for example, salary sacrifice. You can sacrifice your salary on the one hand, and the company can make contractual pension provision for you on the other. The net result is you end up with a lower income, and therefore it improves your tax position. But on the other hand, pension provision is being made. So that's the point on adjustment of contracts. Pension provision, as Treasury and SARS has also pointed out, that when the South Africans return to South Africa, where they've had foreign pension provision from services rendered in terms of occupation, that the income from those pensions are exempt of tax in South Africa. So a very, very beneficial bit of legislation, obviously meaning that when you return to South Africa, you can live tax-free on your pension income. Changing circumstances, that really relates to residency and figuring out where you are or aren't residency, and then obviously finalizing your tax status with SARS, either as a non-resident or as a resident in terms of ordinarily residents. One must point out, however, that when you become non-resident, it's a taxable event in terms of Section 9H of the Income Tax Act. So it's effectively seen as a disposal of all of your assets, your worldwide assets. So at the point which they might formalize their tax status as non-resident, which many people might be able to do rather than falling under the ordinarily resident status, it will result in a tax charge in terms of capital gains tax on worldwide assets. So there's that one-off sort of tax to pay when you become non-resident on a formal basis. That sort of brings us on to the concept of financial immigration. Often spoken about, very, very misunderstood by many. Effectively, formal financial immigration or formal immigration is the process where you go to the Reserve Bank, tell them that you're emigrating, and get the Reserve Bank permissions to export your currency, export your cash, sell up your assets and export them from the country with Reserve Bank permission. It also requires a tax clearance from SARS at the same point in time. So it is really the sort of the last step that one takes. As I said earlier, that process of formal immigration will result in a tax charge, and you will then get your exchange control clearance, and you can export your funds. If your client has absolutely no intention of returning to South Africa, it's probably a consideration. And if they're going to formalize their status as non-resident, possibly the right thing for them to do. However, if they are simply doing that to try to avoid becoming resident, in their mind, when they might already be a resident, it could lead to an awful lot of problems in the future. There's something which is called failed immigration in South Africa, and if they come back within a 5-year period, you'll probably find that they will be having to recomplete tax returns for the previous 5 years and face an income tax bill in relation to that, as they are deemed to have remained residents. So it is something that shouldn't be done lightly, and it really should only be done by those people that have absolutely no intention to return to South Africa and have made a totally new life for themselves elsewhere. The thought that you can financially immigrate and somehow remain in South Africa is wrong and very misguided, even though we see a lot of people talking about trying to achieve that. The other point to make is the handing in of passports. We have a lot of people talking about, well, I'll just give up my citizenship and therefore I can't be taxed. The point here is that citizenship has absolutely no bearing on income tax. It's all to do with residency as defined by the Income Tax Act, and there is no mention of citizenship within the actual Income Tax Act itself. So again, simply by being a national or a citizen doesn't automatically mean that you have to pay tax, or on the other hand, that you don't have a right to pay tax. I think it's also worthwhile noting from the consultation that Treasury did, they labored the point, the fact that just because you've emigrated and formally emigrated doesn't mean that you aren't still liable for tax in South Africa. And we've seen examples of this where people have emigrated, albeit they still meet the conditions of ordinarily resident, and therefore they still have a tax liability. So they haven't achieved anything in practice. They've just actually complicated their lives. So again, financial immigration, giving up passports, giving up citizenship doesn't necessarily change the outcome in terms of residency. They are separate. They are separate topics, and they need to be dealt with separately. I suppose the big outcome for people is if they don't do anything. So if they're not using the exemption in terms of the 183 days, a lot of people are going to be paying 45% tax when previously they were paying 0. So it is really important for people to start to plan based on the content that we've been given here in terms of what you can do and the exemptions that are available to you. So if I can sort of let me quickly go to I just want to go to the chat room to see what we've got here. Okay, someone's pointed something out to me. At the start, I said that you need to meet both tests to be South African resident. But then I mentioned that you only need to meet, yes. So there are two tests that apply. If you pass one of those tests, you are South African resident. So yes, just to make that clear, thanks for that question. Yes, you have to pass one of those tests. If you pass one, then you're a resident. So you'll either be resident in terms of the physical presence test, or you'll be resident in terms of the ordinarily residence test. Obviously, if you fail both of them, you are non-residents. Okay, Gareth picked up on that as well. And so did Neil. Thank you very much. Again, if you've got questions as we go along, there is a chat function. You can pop those in. Depending on how much time we have at the end, I might also be able to open the call up to questions, which you can then ask through, over the mic. But we'll see how we're doing for time. So what's the problem? Just to recapture where we are. If you're resident, tax resident, you have now got tax on worldwide income, and that's both gains and income. And of course, you've also got to consider estate duty. A lot of South African expats, they're living outside the country. They forget the fact that they are resident here, and they don't have just the Income Tax Act to contend with. They also have the Estate Duty Act to contend with. I'm just having someone else made a comment here from Renee. Renee's comment, Renee sent me a private note, but she's confirming this issue of people becoming non-resident and the tax charge at the point at which time they become non-resident, and the significant cost that tax charge can actually bring, particularly when people have had assets for a significant period of time. And there's been significant gains on those assets. They could really become very, very costly to formally emigrate. Thanks for that comment. So let's have a look at the problem. These South African expats, they have a lot of existing assets. As a diaspora, they are savers. They accumulate wealth, and they accumulate them through a variety of different assets, which we'll look at just now. And those assets are obviously providing an income. And they are, if they are resident, they are obviously subject to normal capital gains tax as a person living in South Africa would be, that was physically present. And they also obviously to taxation on the income, be that dividends or interest, coupons, rental income, etc. So the issue for a lot of these people is that at the point in time which they normalize their affairs, you might find that they haven't necessarily been paying tax on their foreign income whilst outside of South Africa. Remember, the exemption on income was actually on earned income, not other forms of income. So they need to normalize their affairs, and that would bring all of their assets into the tax environment, which obviously could create a significant cost to them. And of course, estate duty is something else that they need to consider if they should pass away, which becomes more complicated if you pass away in a foreign country because of probate and situs, and I'll touch on that a little bit later. So I think the point being that when we start to look at the planning side of things, there's two sides to this. Your clients have existing assets. What are you going to do with those existing assets? And then they have earned income. And how are you going to help them with that earned income to try to normalize their position and take advantage of what's available to them? So in this slide, I've tried to sort of break things down, and my little piggy bank is effectively, this is cash in the bank, money sitting in the Isle of Man, in Switzerland, where in the UK. It's offshore cash that's sitting about, hard currency. A lot of your expats will have a significant amount of investable cash. A number of them will also have contract-based investments. These are your offshore bonds, offshore life policies. These are unit-linked investment-based contracts that they have. usually rather tax efficient structures. And then they'll have the unit trusts and stocks and shares and portfolios and trading accounts and who knows whatever else of securities. And the other thing that's really common to this group of people is that they have a family. And that's the kind of mix that you're sort of dealing with. And as I said at the previous slide, it's actually looking at this not just from the income perspective. And I'm not going to go through all of these points, but you'll generally find that they don't, or they have not considered asset protection. So they haven't considered that catastrophe event, they get sued, there's a claim against their estate, some catastrophe event which actually lays claim to their assets, and they lose those assets that they've accumulated. They also generally won't have put those assets into structures which allow them to roll up the investment growth or income on a tax-deferred basis. They won't have considered death and what will happen in terms of the passing on of those assets, particularly in foreign territories, where they don't have foreign wills and they have to follow the local rules of probate, and possibly subject to death and estate duties in foreign countries as well. So whilst these expatriates, and this is a sweeping statement, I'm sure some have made proper provision, but what we generally see is the majority of them have been very good at accumulating assets and actually investing them, but they haven't been good at the financial planning piece, but the broader considerations around those assets, making them more efficient, and also ensuring that the family's looked after should something happen to them. So this all sort of ties together and is almost crystallized by the repeal of the foreign income exemption. It's actually, in some ways, it's a catalyst to get them to start to consider financial planning properly, which they haven't really had to do because of this tax-free environment that they've found themselves in. It's made them very complacent to all the other areas in respect to financial planning. When we look at the concept that I'm going to put forward, we are only looking at it from a retirement perspective. We're a retirement plan provider. That's what we do. We do pensions. I'm sure there are other options and solutions to these people outside of this. But what I'm going to focus on is the use of retirement structures as part of a broader financial plan to improve their position. And I will do a worked example. I'll crunch the numbers as well for you following this slide. So the first aspect is looking at consolidating those existing assets that they have into a retirement plan. The important bit is, why would they do that? Well, they would do that because once they've got these assets into the structure, you're sitting in a tax roll-up, a tax-free roll-up environment. So the gains and income being generated from those assets, which would be taxable if they were outside of the structure, now become tax deferred because those gains are sitting inside their retirement plan. So tax-free roll-up through consolidation into retirement plan, an important point. The other aspect here is that once those assets are in the structure, they have full asset protection. Claims against their person or their estate cannot be made against the retirement plan. Another thing that South African clients do worry about is social, I should say political sort of policy in South Africa towards wealth is socialist. The government focuses on policies of wealth redistribution because of the macroeconomic picture in South Africa, the fundamental makeup of the country. We've got significant poverty in the country. The distribution of wealth is not equal, and obviously the leading party's background is a socialist psychology. Even though it's a capitalist democracy, we still have socialist policies coming through. So therefore, and if we look at the Davis Tax Committee's final paper that they did before they wound up, it was a paper on wealth tax, where the committee was recommending that South Africa introduces wealth tax as a process to assist with the redistribution of wealth, to make things fairer in the country. So one of the issues here that people returning to South Africa, one of the fears is, how do I protect my money from nationalization of wealth, or one of those things? Again, your international retirement plan is not subject to the laws of South Africa, and therefore provides that protection. So your expat can go back to South Africa, can live there, they can enjoy what they want out of the country, knowing that their assets are protected from political risk, but also that claim against them, they get sued for something, those assets are legally protected from such claims. If we then move to earned income, and this is really where you look at sort of contractual devices to change the nature of the employer-employee relationship. By that I mean utilizing salary sacrifice. So your employer and employee could have the right to renegotiate their contract, give up some of their earnings in return for contractual pension contributions by the employer. Salary sacrifice as a legal principle is a generally accepted principle worldwide. And in South Africa, there are a number of significant court cases, both in the High Court and in the tax courts, where the concept of salary sacrifice is absolutely upheld. And therefore, the end game is you can reduce your earnings, which ultimately has an impact on the level of tax that you're paying. We will produce a paper on salary sacrifice. There are certain things that you have to be very aware of. There are certain things that you need to ensure you don't do, otherwise you don't get the benefit of the salary sacrifice, and you could still end up in a position where you're being taxed on the contribution. So it's not clear cut. As I said, we will produce a paper on it, and we'll also provide some contacts for specialists in this area, particularly if you've got clients abroad who can help and assist with ensuring that those contracts are redrafted in a way that is compliant and fits in with the South African, I suppose, legal systems to ensure that they will achieve the right outcomes. But the point being that the Treasury Review Committee also made this comment, which is people need to consider their contractual their contracts, because everyone is paid everything in cash, which is not common across the developed countries in the world, where we have a very different sort of package of benefits. And again, those contributions, those contractual contributions, can go into as employer contributions into a retirement plan, such as the Opus plan that we run, where employer and employee contributions are segregated. The next bit is looking at drawing benefit when you return. So once these expats return to South Africa, the other point that's been made is the foreign pension exemption does apply. Now that is specifically relevant to the employer contribution. Actually gets the exemption under 10.1 GC2, which means that you can have a tax-free income in South Africa. Yes, you didn't get tax relief on it, but you are getting a tax exemption. You would have also got the benefit of a slightly of reducing your salary. So there are already mechanisms in place to help expats alleviate the full effect of taxation in South Africa. And it's ensuring that your clients look to utilize either these contractual devices or the exemptions that are available to normalize their tax position. I think if we sort of look at a number of points, I'm just going to run through these. These are points which may find purpose in the letters of advice or the advice records that you're giving clients, and I have touched on these already. But your retirement structure obviously gives you your asset protection. It gives you your roll-up of gains and interest and dividends, so your tax-free roll-up environment. Again, holding assets in one's own name in foreign countries means you're subject to the laws of succession in that country, and you need a will. Those issues are purely mitigated with the retirement plan. Death duties don't apply. foreign probate doesn't apply, the rules of succession doesn't apply. They are all dealt with through the retirement scheme. Products such as the Opus has significant benefits or options in terms of benefit. This could be lump sum payments, it could be full computation, it could be regular drawdown, it could be a combination of all of those. So your international retirement plans are incredibly flexible when providing the type of benefits that your client might need to sustain a lifestyle that they need. Very importantly, your expat, when they return to South Africa, the last thing they want to do is return their funds to South Africa. They don't want the implications of exchange control. They don't want to be in rand. They want to remain invested in hard currency, and of course, they can all achieve that very legitimately through their international retirement plan. And which is the point there, they don't have to consider exchange control. So what you end up by looking at those devices is the possibility to mitigate a certain amount of tax. I don't think it's possible to pay no tax, of course, unless you're under the million threshold. I'm just going to go to the chat room and see if we've got any other questions in here. I just want to have a quick look. I'll see what we've got. I just want to have a quick look here. I've got some questions. Right, let me just bear with me 1 second. I'm just getting the relevant piece of paper. Okay, so the question we've had, a number of people have asked the question about is Section 10(1)(gc) relating to the contribution to the pension being exempt, or relating to the withdrawal being tax-free? Very good question. It's been asked by a number of people. I think, Brett, you were the first one to get that question in. Thank you for that. Yes, this is the exemption sits with the income. So the member doesn't get tax relief if they make a contribution to an international pension scheme in their personal capacity. Because that scheme is not a South African pension scheme approved in terms of the Pensions Fund Act, there is no tax relief. However, what 10(1)(gc) does, it takes into account the fact that there was no tax relief, and therefore exempts your pension payment on the way out. So it's the reverse, where obviously you make a contribution to an RA in South Africa as a resident here, you get your tax relief. When you take your funds out of your RA, yes, you've got a tax-free lump sum, but after that you pay income tax on your pension. This is the exact opposite of that. There's no relief on the contribution, however, it's tax exempt on the way out. So that's how the structure works. Another question here: what type of a pension is the Opus retirement plan? It is a personal pension plan, and it is a pension scheme that is registered and regulated out of Guernsey. So the schemes that we run on the whole are Guernsey schemes. And they are also qualify as pension schemes in terms of common reporting standards, yeah, so they qualify under CRS. The point being, is people often ask, well, what is a foreign pension plan? What do you need for it to be a pension scheme? And it's very similar to what you'd have in South Africa. You need a scheme which is set up specifically for the purpose of retirement provision. It must have authority in terms of legislation, so there must be pensions legislation that brings the thing into existence, and it must be regulated as a pension plan. Once you've got those conditions met, then the scheme is effectively a pension plan. If we sort of take that forward, in terms of the exemption, in relation to the previous question, the exemption on pension income only applies to the contribution made by the employer. Yeah, very, very important. As I said, we segregate contributions. We segregate member contributions from employer contributions. This is specifically to deal with tax. So all the contributions you're drawing that were made by the employer are tax-free, because it was a employer-employee relationship that led to that contribution. So those are that's the income or the pension benefit that is exempt from tax in South Africa. If the employer also made their own voluntary contributions into that scheme, yes, no tax relief on that. But when it comes to drawing those personal contributions, the capital that they put in can be taken out without any tax. However, the growth within the pension, when I spoke earlier, I talked about long-term tax deferral. Tax-free roll-up with tax deferral, and this is where the deferral ends. At the point in which time those gains or income is taken, it will be taxed as such. So if we take an example, I got 100 in my pension, I got 50, which is employer, I got 50, which is my own money that I've put in, and I start to draw. I could choose to draw down all my employer contributions over time first and be exempt from tax on that. I could then choose to draw down all my capital contributions and not be subject to tax on that, and draw out after that. I'll draw out my gains and my income from my pension scheme, which will then be subject to tax. So that is how the taxation of your international pensions work. Another question coming in: what percentage of salary sacrifice can one make? Is 50% safe? Well, that's a difficult question. But let me go on to an example so we can actually look at how this works in practice. Right. Let me just swap to a pen highlighter. I think if we look at this example, and again, provided you're 183 days out of the country, 60 consecutive, here we have an executive, they're earning $150,000. I have made the assumption that the rand is 14-1 in terms of the dollar, so their exemption, their income exemption, is going to be 70,000. That gives them a net income of 80,000. I've discounted the allowances for the purposes of this simulation, and therefore we're saying that they have a taxable income in dollar terms of about $80,000. And if you look at the current tax tables in South Africa, you will find that their tax rate or their tax payable on that is going to be about 376,000. So their $80,000 equates to about 1.1 million rand, and it's the rand figure that the tax tables get applied. So obviously, looking at the current tax tables, they will be paying their 708,000 in tax plus the additional 41% on the excess. So you'll find that their tax rate is around about 370K. So their actual tax level, the actual rate of tax they're actually paying is 18%. So the reality is, it is not as bad as what people are making out. However, 18% is still greater than zero. So one can see why people are protesting, but I don't necessarily think people have actually thought through the calculations in too much detail. Well, now let's look at the same scenario where someone has utilized the salary sacrifice. In this scenario, they've effectively had a third. They've renegotiated their salaries. They know what they need to live, and they're getting a salary sacrifice of 50,000. In return for a pension contribution. So their gross income is the 100,000. They're getting their 70,000 exemption. So their net income is down to 30. Their taxable income in terms of rands is 420,000, and we see their tax rate based on the tax table effectively drops down to 31%. So their effective rate of tax here through salary sacrifice has been taken down to 5%. Absolutely nothing wrong in doing this. A lot of people have said, well, it's totally unfair. If they were living in South Africa, they'll be paying the full amount of tax. But that's the purpose of the exemption. The exemption recognizes that these people aren't utilizing all the services and infrastructure in South Africa, and therefore the exemption was put in. The original consultation, the original proposal was there was no exemption, but following consultation, the points were made that it's not really fair because these people aren't there, albeit their intention is to return to South Africa. So your expats are still in a favorable position. Whether or not they adopt a salary sacrifice mechanism to help offset some of the tax. And if they do opt for salary sacrifices, obviously potential benefits there. Of course, it's a trade-off between how much cash you need to sustain your lifestyle. Do you change your lifestyle? But as I said, a lot of these people are prolific savers in any case. So really what they're doing, the restructuring of their contracts is effectively achieving their same savings outcome in the long term. I'm just going to go to chat room quick. I've had a few more questions in. We've got about another, someone says, when are we finishing up? Because I need to run, probably another 5 minutes. What percentage can you put in? I can't really answer the question as to what percentage you could put in. I think there's lots of factors. What is reasonable? Yeah, and I think it depends on how long your contract is. If you've got a very short contract, you might want to contribute more to a pension scheme. If you are earning a lot and there's a lot of disposable income, you might want to contribute more. But I think on the balance, if one's looking at a third, between 25% and a third, that's probably reasonable to do that. It would seem in line with where contributions are made in around the countries around the world. We'll typically see anything from 20, 25, 30% is the level of contributions people would make to domestic pension schemes. And obviously, in fact, in South Africa, your tax relieved element is obviously the 350 per year, but there's nothing stopping you from contributing more. So I think it's a very personal thing. I think common sense does have to come in, and things have to be done in a proper fashion. I suppose is the point to make there. I know that doesn't answer the question, but I think that's the principles. If someone sort of followed those principles, that's going to bring me on to the conclusion. And if I can sort of summarize things, the South African expat market segment is a very interesting segment for advisors. As I said, these people are prolific savers. They've got lots of accumulated assets. And the thing is, they have a real need now to start to plan. They haven't had a need to plan previously. They've just accumulated assets. So as a client type to deal with, I would say they are good customers to deal with. There's good economic sense in dealing with these people, and you can actually provide solutions which are going to make a marked difference to their lives, and therefore probably a very good client type. The solutions that we're looking at here, they're simple solutions. They're compliant. There's nothing here that's looking at loopholes or doing things that are untoward. This is simple, straightforward planning following Treasury guidance, and utilizing the exemptions and contractual devices that are available and used by people currently. I think for those people that get stuck on the argument, are they resident, non-resident, what are they? Those people are going to end up in the position where it's going to cost them. But it's also recognized that some people will have to implement these kind of arrangements over time. You might not necessarily be able to do them all at once. Negotiating contracts might be something that the employer doesn't understand. They need to understand why this needs to be done. That might take time. We've got up until March next year to do it. So clients can implement these kind of arrangements on a staged basis. Stage one might be consolidating those assets, putting those into the pension scheme. You've dealt with that. You've now got your tax efficient and environment fully protected. Then you deal with the contractual obligations in respect of employment, and eventually deal with those so that you, by 2020, you've sort of worked through the different aspects you need to do to get one's affairs in the best state possible. And obviously, we provide the product solutions, and we are used to dealing with employers and employees making contributions through the company and or through the individual. So this is something that we do. We do it for many expatriates of differing nationalities around the world, and we have existing products all set up and ready to go. We're not going to talk about our products on this call today, but you're all welcome to contact myself or my colleagues, where we can start looking at the actual product proposition at a different time. I just want to see if there's any further questions. Any further questions? I'm just conscious of time. Any further questions here? Perfect. Yeah. No, just some people expressing an interest in understanding a bit more about salary sacrifice, and having contacts sort of in terms of people that can assist with employers. Okay, I think that brings me to the end. I appreciate that everyone's been sending me messages throughout the call. Therefore, I'm not going to open up to questions. I think we've had some good questions come through. If anything does come to mind after the call, please do send me an email, or send Natalie an email, and I'll deal with your questions. We will be sending out a link to the webinar, so you can dip into it at any stage that you wish online. And I'll also be sending out the income tax interpretation notes in respect of ordinarily residents, so that you can read that. So you've got that. We've got a bulletin coming out as well, which you will get probably in the next 10 days, which looks at all of these issues around system of taxation and residency and double tax treaties and that. But it's going to be in a format that you can give to a client, so that they can actually read it and digest it as well. It's important for them to obviously get those understandings. But thank you very much for your participation.